Everyone thinks markets react to reality. They don't. They react to signals. Not what happened. Not what is happening. But what might happen, based on hints, whispers, probabilities, and expectations layered on top of expectations. That sounds abstract. So let's make it uncomfortable. A company can lose money, fire workers, miss targets, and its stock can soar. Another can post record profits and get punished. The economy can feel strong, wages up, jobs plentiful, and markets panic. Or everything can feel broken, and markets rally like nothing's wrong. This isn't madness. It's how the system is built. And right now, misunderstanding this is costing people real money. Here's why. Right now, people are confused. They look at headlines and feel gaslit. Inflation cooling, but prices still high. Rate cuts promised, then delayed. Earnings beat. Stocks fall anyway. Bad news hits, markets rally. It feels backwards. It feels rigged. It feels like someone else got the memo. They did. Because markets don't trade reality. They trade expectations about the future, and more specifically, changes in those expectations. Think of markets less like a scoreboard, and more like a betting market. When you buy a stock, you're not saying, "This company is good." You're saying, "I think the future everyone else expects is wrong." That's it. If everyone already believes good news is coming, the price already reflects it. When the good news arrives, nothing happens. Or worse, the price falls. Because the signal is gone. Let's slow this down. Imagine a movie everyone is hyped for. Trailers look incredible. Reviews are expected to be great. Opening night comes. Reviews are good. Not amazing. Just good. The movie didn't fail. But the expectation did. And the stock drops. Markets are the same. They move not on outcomes, but on the gap between expectation and reality. That gap is where money is made and lost. And this is where things get dangerous. Because most people only see the surface. They see inflation at 3% and think, good. Markets see inflation at 3% and ask, what does that mean for rates 6 months from now? They see strong job numbers and think, healthy economy. Markets see strong jobs and think, rates stay higher longer. They see a rate cut and think, bullish. Markets think, why did they have to cut? Same fact. Different signal. Let me tell you a story. In 2020, markets crashed before most people understood what COVID was. Before lockdowns. Before death counts dominated the news. Why? Because markets weren't reacting to reality. They were reacting to trajectory. They saw exponential spread. Supply chain stress. Policy paralysis. The signal was clear before the reality arrived. Then something even stranger happened. The economy shut down. Unemployment exploded. GDP collapsed. Markets rallied. Not because things were good, but because the signal changed. Stimulus. Liquidity. Rates to zero. The future looked different than expected. This pattern repeats over and over. Markets bottom when news is worst. Markets top when news feels best. Not because they're evil. Because they're forward-looking machines. Cold. Probabilistic. Unemotional. And right now, that machine is obsessed with one thing. Not inflation. Not earnings. Not even growth. But policy reaction. Markets don't ask, is inflation falling? They ask, is it falling fast enough to change behavior? They don't ask, is the economy strong? They ask, is it strong enough to delay relief? This is why good news can be bad news. Strong retail sales? Rates stay high. Low unemployment? Rates stay high. Wages rising? Rates stay high. Each positive data point pushes the future further away from what markets want. And what markets want is simple. Lower rates. More liquidity. Cheaper money. But here's the uncomfortable math. Markets don't need rates to fall. They need rates to fall faster than expected. If everyone already expects cuts in 6 months, and they happen in 6 months, nothing changes. But if they happen sooner? Markets explode. If they get pushed out? Markets wobble. This is why listening to headlines is dangerous. Headlines talk in absolutes. Markets trade in deltas. The change matters more than the level. Let's talk earnings. When a company reports, people think the question is, did they make more money? It's not. The real question is, did they change the future? Did guidance move? Did margins surprise? Did demand inflect? A company can miss earnings and rally if the signal says the worst is over. Another can beat and fall if the signal says peak growth is past. This is why markets often sell rallies. When optimism gets too loud, it stops being useful. Because once everyone believes the same future, there's no edge left. This creates irony. The market needs doubt to climb. It needs fear to find buyers. The most dangerous moments are when certainty feels comfortable. And right now, certainty is creeping back in. People feel like they understand the playbook again. Rates will come down. AI will drive growth. Soft landing achieved. Maybe. But markets don't care about stories. They care about surprises. And surprise is disappearing. Here's where the system gets fragile. When everyone positions for the same future, small signals carry enormous weight. A single jobs report. A sentence in a press conference. One word change in guidance. Suddenly, trillions move. Not because reality shifted overnight, but because the signal did. This is why volatility clusters. Why calm breaks suddenly. Why markets feel fine, until they're not. It's not random. It's expectation compression. The tighter expectations get, the more violent the release. And this isn't just about stocks. It's housing, crypto, bonds, currencies. All signal-driven. Crypto doesn't rally because adoption doubled overnight. It rallies because liquidity expectations changed. Housing doesn't cool because people stopped wanting homes. It cools because financing expectations shifted. Everything flows through the same lens. Signals first. Reality later. This creates a dangerous illusion. People think markets are detached from real life. They're not. They're just early. Sometimes uncomfortably early. And sometimes, wrong. Signals can mislead. Models can break. Assumptions can rot quietly. When that happens, markets don't gently correct. They snap. Because signals unwind faster than reality ever could. That's the real risk. Not bad news. But mispriced futures. So what do you do with this? You stop asking, is this good or bad? And start asking, compared to what was expected? You stop reacting to headlines. And start listening for tone shifts. You watch what markets ignore. That's often more important than what they react to. And you stay humble. Because signals change faster than narratives. And narratives change slower than reality. Which means most people are always late. One final thought. If markets truly reflected reality, they'd be calm, stable, and boring. They're not. Because they're not mirrors. They're prediction engines. And prediction is never clean. So the next time markets move and it feels irrational, ask yourself one question. What signal just changed? That you didn't hear yet? And more importantly, what signal is everyone already convinced of? That might already be priced in.